Hey guys, welcome back to my channel. My name is Alex. Today I am going to give you an improved version of the vacation strategy. For those of you who are not familiar yet with the RBV Vacation Strategy, let me just give you a quick insight about it. So the strategy is extremely simple. We're focusing on the H1 candle that opens at 12 a.m. New York time zone, and therefore it's going to close at 1 a.m. New York time zone. Okay, so let's just say that we are going to have a bearish candle here on the 1 hour. Right, it opened at 12 midnight New York over here, and then it closed at 1 a.m. New York over here. So now we have the high of the candle and we have the low of the candle. Now, after that candle closes, we want to drop down to the 5-minute chart. And over there, once we are going to see a 5-minute candle that closes below the bottom wick of the 1 hour candle, that's where we want to sell over here. Or if a candle, 5-minute candle, closes above the top wick of the 1 hour candle, 12 a.m. candle, then that's where we want to buy at the close of that 5-minute candle. Okay, so the strategy is extremely simple. The stop loss in case of a sell is going to be 10 pips above the high of the 12 a.m. candle. And in case of a buy, it's going to be 10 pips below the low of the 12 a.m. candle. Now, in some cases, it happens that the strategy is going to give you an entry and then it is going to go in a drawdown. Not a drawdown that's going to go to your stop loss, but it can actually go in a drawdown. For example, if we're focusing right now on the 5-minute chart, because that's basically where we are going to take our entry from. Like I said, we just want to wait for the 1 hour candle that opens at 12 a.m. New York and closes at 1 a.m. New York. We want to wait for that candle to close, right? So in this case, on my chart, that candle is always going to be marked by these two vertical lines that you see on my chart. Okay, so the two vertical lines are basically the beginning of the 12 a.m. candle and the close and the end of the 12 a.m. candle. So in this case, we have the high of that range and we have the low of that range in here. In here, you can see that this 5-minute candle closed below the bottom wick of the 12 a.m. candle. Okay, so basically once that candle closed, that's where our entry would have been. So we would have had an entry at the close of that candle, basically at the open of the next candle. Stop loss would have been 10 pips above this high. So from our entry, which is here, till that high, we have 30 pips, so another 10, that's going to be 40 pips. So 40 pips stop loss in this case. And we are always targeting 20 pips. We have a negative risk to reward ratio. However, just remember that this is a high win rate strategy, right? So our stop loss, 40 pips, and our take profit, 20 pips. So that would have been something like this. And we can see that we get that within the first 6 candles. So after about half an hour, you've gotten your TP1. However, there are instances, like I said, where you are going to enter in the trade right here. And first it's going to go in a drawdown, not hit your stop loss. Usually your stop loss is not hit. And only then it is going to go in your favor. Now, there are 2 cases that I'm going to present to you, 2 solutions that I have for you.
Before we continue, I want to take a few seconds and thank Hanko Trade for sponsoring this video. And I do want to share with you the reason why I've actually decided to switch to Hanko Trade. They have a great variety of accounts, starting with standard accounts, ECN accounts, ECN Plus, and also Islamic accounts. They have a minimum spread. It starts from 0 pips. They have a max leverage of 500, smallest commission in the market, $2 per 1 standard lot. They have a 100% matching bonus promotion. Click the link below in the description, sign up for an account with Hanko Trade. They have an excellent customer service. Once you deposit at least $100, they are going to match that with a 100% deposit.
Let's go, for example, on the 1-minute chart over here. Before we do that, I want to mark the high of the 12 a.m. candle, and I also want to mark the low of the 12 a.m. candle. So we're going to do it like this. And we want to see when is the 5-minute candle, the trigger, when did that candle open? So this candle here on my chart opened at 8:05 a.m. So basically that would have been at 1:05 Eastern Standard Time, New York time. Okay, 1:05 in the morning or a.m. So in this case, I want to drop down to the 1-minute chart and see what that candle did prior to closing below my H1 candle's range. Now, before I go there on the 1 minute chart, I'm not going to see all this price action. All this price action is not going to exist. So what I am seeing at this point is that the 1 hour candle has that high, has this low, okay? And we have a fair value gap over here that has been created towards the downside as that 1 hour candle was trading, okay? So what I want to do is I want to mark that fair value gap like this, and I want to drop down to the 1 minute now, and I want to see what the price action over there would have looked like. And here on the 1 minute, I also want to mark right now just for you guys to see, okay? So I also want to mark the opening candle of the M5 trigger, the M1 candle that was the first trading minute from the M5 entry trigger, okay? And in our case, it would have been this candle, 1 minute candle that opened at 8:05 a.m. So basically, it's this candle, okay? Now, our charts are going to look like this, okay? So what I can see prior to getting that M5 entry trigger, so far, all that I know is that I have the high of the 1 hour candle and the low of the 1 hour candle. We breached below the low of the 1 hour candle, but we didn't close below it, not on the 1 minute, not on the 5 minute, okay? So we don't have an entry yet, an entry trigger yet. And you can see that the candle that opens at 1 a.m. and closes at 1:05 a.m. So basically the first 5 minute candle that trades after our H1 candle has closed. This is the first trading minute from that M5 candle. So it's minute number 1, 2, 3, 4, 5. So all these 5 candles are basically the M1 candles that are building my M5 candle, the first candle that opens after the 1 hour candle closed. Okay, so in this case, what I want to do is I want to see when will price enter into the fair value gap that has been created on the 1 hour candle, but it has to be a M5 fair value gap. Okay, so I have the H1 candle that opens at 12 a.m. and closes at 1 a.m. Okay, after this candle closes, I want to drop down to the 5 minutes and I want to see a fair value gap, the most recent fair value gap that has been created on the 1 hour candle, but I want to break that down into 5 minute candles, okay? And then I want to mark that fair value gap. So this is the green shaded area that you can see in here. If you will see price action prior to giving you an M5 entry trigger, so basically prior to having an M5 candle that's going to close either below the low of your H1 candle, either above the high of your H1 candle for a buy, okay? In this case, we had a 5 minute entry trigger for a short position, but we couldn't have known that prior to having it, okay? So I'm seeing that I have a bearish fair value gap, so a sell side imbalance, buy side inefficiency, okay? I see that the first 5 minutes after that H1 candle closed are going up into that fair value gap and are rebalancing, okay? So now let's see what price action is going to do. Remember that this is going to be the first minute from the next M5 candle, okay? So let's see what price action is doing. So now we have the next M5 candle that opens, right? And we have minute number 1, 2, 3, 4, and 5. So basically, once the 5th minute from the next M5 candle closes, that's also where our M5 entry trigger has happened. And now I want you to take a look at what we see in here. Okay, so we have the range of the 1 hour candle starting from 12 midnight New York till 1 midnight New York. And we have this sell side imbalance, buy side inefficiency on the 5 minutes chart on that 1 hour candle's body. Okay, now if you take a look in here, you can see that on the 1 minute, you can actually refine this fair value gap. And we have a swing high in here. What do we know that resides above swing highs? We have buy side liquidity. Okay, so now what happens after price within the next second M5 candle that opens after our 1 hour candle has closed? we can see that price goes above that swing high, doesn't close above it, it just pierces through it, and it's also rebalancing at the midpoint of this M1 fair value gap. The M5 fair value gap, which we have previously refined here on the M1, okay? So we have a H1 range, we have a fair value gap, sell side imbalance, buy side inefficiency, we have buy side liquidity, and we have buy side liquidity grab, and then we have speed and distance through this candle, which is basically the 5th minute from our M5 entry trigger for us to take a short on the vacation strategy. Most likely, I can actually reduce my stop loss instead of having it 10 pips above the high of the 1 hour candle, which would have meant I would have had, in today's case, a 40 pips stop loss. I can actually bring my stop loss down to either having it a few pips above this high or a few pips above this high. This is an option because this high took buy side liquidity and it was a rebalancing move into this sell side imbalance, buy side inefficiency. And then it moves away from that fair value gap through this candle with speed and distance. So now stop loss just a few pips above this high would make complete sense, simply because if that candle took buy side liquidity above this high and rebalanced this fair value gap, then if price goes back above that high, I want to stay out of the trade. I don't want to be in the trade anymore, because chances are price is going to go even higher and it might actually just want to grab buy side liquidity above that high. Now, also the second area at which you could put your stop loss in this case would be above this high, okay? And it would also make complete sense because this is the origin of the fair value gap that has been created on the H1 candle. If price is going to want to go above that high, again, it should not want to do that. Why? Because supposedly this is where the algo is starting to push price down, creating this imbalance. So if a sell side imbalance, buy side inefficiency is then going to be invalidating by price going above it, either by closing above the fair value gap that it created, either by just going above the swing high that it came from, then again, I don't want to be in that trade, right? So in this case, if we would have had an entry here all the way till the high of the H1 candle, we have almost 30 pips. If we add another 10 pips buffer for our stop loss would have actually been 40 pips. Now, with this improved skill set, if you want, okay, you can have your stop loss either above this high, a few pips. So till this high, we have about 13, 14 pips. Till this high, we have 18 pips. So adding another 2 pips above that high would basically reduce your stop loss to half. So now you can actually have a 1-to-1 risk reward ratio. If we go back here to the 5-minute chart and see how this trade would have performed, if you would have left a runner to go for your next draw on liquidity, go to the 15-minute chart and see where the next draw on liquidity would have been, almost 500 pips trade. Let's go through the vacation strategy example that we had yesterday. So we have between these two vertical lines, the 12 a.m. candles range, the 1 hour candles range. And if we are here on the 5-minute chart, again, you're not going to see all this price action that follows after that candle closes. Okay, so in here, all that we are seeing is just the M5 candles that are building that 1 hour candle. Okay, in here, we can see that the only fair value gap that we have on that candles range is going to be here. Okay, so we have a fair value gap towards the upside. So we have like a buy side imbalance, sell side inefficiency, and we have also this SIBI, sell side imbalance, buy side inefficiency. Okay, so we have that one from the bottom of the range, and we have the one from the top of the range. Price goes above the high of the, it doesn't give us an entry trigger, and then it starts to move lower. So what we can see that has happened with this SIBI in here, price went through it, invalidated it because it closed above its top range. It created a buy side imbalance, sell side inefficiency. In here, goes above the 1 hour candles range and then closes below that BSI. We then see it retracing into it, retesting it this time like an inversion fair value gap. So an inversion fair value gap, for those of you who do not know, it's basically when we have a fair value gap, price then breaks below it with bearish candle. So we have candle closing below the bottom level of the BSI, and then if it pulls back above into it, so right now it's retesting it as if it was a resistance. Okay, now if we're going to see candle closing bearish and ideally breaking below the low of this candle, then basically that's an inversion fair value gap and the way in which you would actually trade an inversion fair value gap. Okay, in here what we can see happening is that this BSI is then invalidated and now it's tested above here like a resistance, like I said, inversion fair value gap. Then price goes lower, reaches at this BSI, and after this we have our M5 entry trigger. Let's take a little arrow and put it on that candle. Our entry would have been here and our stop loss would have been 10 pips above the high of the 1 hour candle. We have 65 pips till the top of the 1 hour candle. And if we add an additional 10, that would have been 75 pips, which is a lot. Is there a way in which we can reduce the size of our stop loss? So let's see. We go here on the 1 minute chart. You would not see all this price action. That's the first minute of your short trade. What you can see that has happened on the 1 minute chart during the trading of your 5 minute entry trigger, what is the pink range that I have in here? That's the 5 minute buy side imbalances, sell side inefficiency that has happened on your 1 hour candles range. Price closes below it, closes back above it, closes below it, and now it retests it as if it is an inversion fair value gap. And then you get your entry trigger. When you enter your trade, you know that price should not go above this high. Why? The sole reason why price went up in here was to retest the BSI from the 5 minutes like an inversion fair value gap. You have a buy side imbalance, sell side inefficiency, which is now broken towards the downside, retested from the downside up, and now it acts as a resistance. If it goes above this high, you want to be out of the trade. Remember, in here with a classical vacation strategy, stop loss would have been 75 pips. In case of this, our entry is here and my stop loss can go just a few pips above there. 22 pips, add another buffer of 2-3 pips, just round it to 25, and there you go. From a stop loss of 75 pips, you've already reduced that 3 times. Now you have a stop loss of 25 pips. Now your trade would look like this. 25 pips of stop loss. You're aiming for 20 pips of profit. And this is how your trade would have looked like. Then you just leave a runner. In this case, it went for a total of more than 80 pips. And I really hope that these tips and tricks are going to help you master the vacation strategy a lot better. You're going to be able to apply these tips and tricks and this like a little more advanced price action analysis, and this is actually going to help you reduce your stop loss a lot. So guys, I hope you enjoyed today's video. Make sure to give it a thumbs up and yeah, talk to you next time. Bye.